I have a new book coming out. The title of the book is The New Great Depression, Winners and Losers in a Post-Pandemic World. So if Aftermath a year ago told you where we are today, this book will tell you where we're going to be a year from now or even further ahead.
Can you give us a hint?
Well, we are in a depression. A lot of people don't know what a depression is because first of all, no one's ever lived through it. If you have a living memory of a U.S. depression, you are 90 years old. And my mother's 90, so she remembers it. We still talk about it, but you're 90 or older if you remember the depression. So very, very few people in that category. Most people have never lived through a depression. They don't know what it is. They assume must be a continuous declining GDP. It's not. Two quarters of GDP, of declining GDP, is the technical definition of a recession. But a depression means depressed growth. You can have growth in a depression. It's just the growth is below potential. So if your potential is 3.5%, and your actual growth is 1.75%, that gap between, say, 3.5 and 1.75, that gap is depressed growth. Now, if your debt is going up 5, 6, 7, 8% a year, which it is, and if your growth is 1.5, 2% a year, which it is, which it will be in my forecast, then your debt to GDP ratio, when your debt's going up faster than your income, you're going broke. It's as simple as that. So, but people aren't. We're looking at intergenerational changes, and again, it all comes out of the COVID pandemic. But the pandemic, the social unrest, and the depression that all converged in 2020. We're not going to be out of this in 30 weeks or 30 months. It's going to take 30 years to get out of it. A lot of people don't know. The stock market reached a certain level in 1929. Do you know when then it crashed 90%? Do you know when it regained the 1929 level, when it got back to the 1929 level? 1954. It took 25 years to get back to where it was in 1929.
This is the first economic shock that most economists can think of that was both a supply shock and a demand shock. For example, in the 1970s, we had a supply shock where OPEC cut off oil exports to the United States and quadrupled the price. And we had gas lines in the United States. You had to line up for hours sometimes to get gas in your car. So that was a supply shock with predictable consequences in terms of prices and inflation and so forth. In 2008, for example, we had a demand shock because unemployment skyrocketed, banks failed, people lost their jobs, people lost their homes, et cetera. So even though the supply side of the economy was fine, people weren't spending. But this is both. This was a supply shock in the sense that China had to shut down to deal with the virus and could not provide components or inputs in the supply chain. So you could have a U.S. factory, for example, that was taking imports from China and then assembling them or combining them with other imports to produce finished products. Well, they couldn't get those supplies. Vessels were not leaving China. People didn't want to unload the vessels, et cetera. Now, little by little, China has been able to kind of reopen the economy. I think it's overstated. I don't think that China's economy is anywhere near as open and productive as it was, but it's reopening stages. But now we have a demand shock where it doesn't matter what China can make. Nobody wants it. Nobody has the money. U.S. unemployment is skyrocketing. U.S. factories are shut down because of the virus. U.S. consumers are locked in their homes. And so maybe China can make things, but nobody wants them. So this is both a supply shock and a demand shock. It's extreme. I think people looking at 2008, the global financial crisis, even 1998 with Russia, we go back to 1994 with Mexico, et cetera. None of these crises are good baselines. If you want to understand what's going on now, you have to go back to 1929. You have to go back to the Great Depression. Of course, in the Great Depression, unemployment went to 25%. We may see unemployment in the United States perhaps reach 25%. But here's the difference. The Great Depression played out in stages, but the 25% unemployment and the 90% drop in the stock market played out over 3 years between 1929 and 1933. Here, everything happened in 3 weeks. So we not only have this simultaneous supply and demand shock, which we've never seen before, but we've never seen movements in prices and stock market indices and unemployment, et cetera, that happen so quickly. So by every measure, this is unlike anything we've ever seen in the United States, outside of, maybe the beginning of World War II, but wars are different And so none of the existing models are really adequate for understanding it. When people say, oh, I have a 20-year time series or I have a 10-year time series, or I have correlation models and regression models and so forth, I say throw them all out the window, because none of them capture what's going on right now. You'd have to be 95 years old or older to have a living memory of the Great Depression. So what we know about it is maybe we learned from our parents or our grandparents who studied it. There are a lot of resources. I'm not saying you can't understand it. I'm just saying that no one alive has lived through it, or very, very few. And as a result, I think that people don't really understand it. There's a lot of talk in the US right now about what they call pent-up demand. And the idea is that, we'll have a V-shaped recovery. So the economy will fall very steeply, very quickly, but it will bounce back equally steeply on the upside and very quickly. And that's not true. It is going down quickly. That part's true. But when it hits bottom, and we haven't hit bottom yet, but when it does, it's much more likely to come back very, very slowly. Not at all fast, not at all strong, for a lot of reasons. Some of these effects will linger. The virus might get under control, but it'll still be around. But more importantly, behavior changes, and it can change for a generation or longer. I grew up in the 1950s. I did not live through the Great Depression, but my parents did, and my grandparents did. And as a young child, you learn from your parents' behaviors. And we saved rubber bands. We collected, the Boy Scouts would go out and collect tin cans and newspapers. And we weren't doing it for, environmental reasons. We were doing it in order not to waste resources. And people didn't spend much. They didn't expend extravagantly. They didn't overborrow. They didn't overpay. All that came later. That was much more characteristic of, say, the 1970s, 1980s and forward, but not in the 50s and 60s. So my point being, the impact of the Great Depression on behavior lasted for 30 or 40 years, through the 1970s. My view is that something very similar is happening right now. The impact of this on everybody, people losing their jobs, hours being cut back, people being ill, people dying, that this will last for a generation. It'll affect people alive today for the rest of their lives. And so, therefore, I don't expect a quick rebound in the economy. I expect a very slow, drawn out, and weak rebound. By the way, I have a whole chapter in my book on the lockdown, the 100-day, the Chronicle of 100 Days, I call it. But it'll be viewed as the greatest blunder in economic history. The old 90-10 rule. You could have got 90% of the benefit of the lockdown from an epidemiological point of view at 10% of the cost. Yeah. Hand washing, sure. Mask, fine. Social distancing, fine. No big sporting event. A lot of those things were smart, and they're still smart. But you didn't have to shut down every nail salon, every pizza parlor, every dry cleaner, every barbershop, every bar, every restaurant. You didn't have to do that. And we did, and we've destroyed the economy.
And it really does seem like there's no end in sight here, Jim. So as we await your book, what can investors and what should we be doing now?
Well, there are a couple things. I have a whole chapter on, kind of investment suggestions, portfolio allocations, and all that. But the main thing to do is a couple things. They're almost constants, not quite, because it's not a set it and forget it type portfolio. But you definitely want 10% gold, and whether it's physical bullion or some kind of fund. I recommend physical bullion, but if you have an ETF or something, at least you get price exposure. Gold mining shares, and you can look at silver miners and all that. But I also recommend a big slug of cash, maybe 30% cash. I recommend lightening up on equities. I think equities have a lot further to fall. There's been a spectacular rally from March 23rd to September 2nd. We had the shortest bear market and the fastest return to a bull market in history. But it doesn't mean this is over. That was sort of, I call the S&P 500, I call it the S&P 6, because it's really only 6 companies that are dragging along the other 494, because it's a cap-weighted index. So when you look at Amazon, Apple, Microsoft, Netflix, Facebook, and Google, or Alphabet, those 6 stocks are almost 40% of the weight of the index. So if they go up, the index goes up. A lot of people don't pick stocks anymore. They just buy index funds. So their index funds go up. So it's all sort of going up together. It's all good. But there are 2 problems with that. Number one, how sustainable is that? And by the way, the 6 companies I mentioned, they're the least affected by the pandemic. Meanwhile, so my point is that the stock market is completely detached from the economy. It used to be the stock market was kind of a proxy for the economy, not exactly, but to some extent. That's not true anymore. Those six stocks and others like it, they're some of the tech names, they're just in a world of their own. The economy is in very bad shape.